Ethical or socially responsible investing, SRI, has gained significant momentum in recent years and has now become a highly credible form of investing one's money, with the objective to deliver financial returns whilst doing good for society and the environment we live in. Fund managers are becoming increasingly aware that incorporating environmental, social and governance (ESG) factors into their investment process leads to an enhanced due diligence process and a more accurate assessment of risk, which can lead to the inclusion of some of the highest quality companies within their portfolios. What's more, ESG issues are now becoming firmly embedded within the investment process of many funds as an added layer of qualitative analysis, regardless of whether they are marketed as being ethical or not. Despite the progress that's been made in this area, the views of many proponents of ethical investing have been suppressed for fear of being heralded as preachers or do-gooders who are not concerned about financial returns. As a result, the common myths surrounding the subject still linger and may be impeding further progress being made. We're here to challenge some of these myths that surround the topic of ethical investing and present the reasons why they should, in fact, be discounted. Ethical investing is niche. Interest in ethical investing has grown substantially in recent years, becoming an area that managers simply cannot ignore if they are to remain competitive and meet the growing demands of their clients. This growing demand is highlighted by the recent launch of several SRI-focused index funds by some of the largest and most reputable investment managers, including iShares, SPDR, and UBS. These represent cheap and liquid ways to invest ethically into broader areas of the market. When we look at the overall ESG market, including active and passive funds, assets under management in funds that integrate ESG criteria have more than doubled since 2016, estimated at over $40 trillion in 2020. We are now seeing some form of ethical or socially responsible investment product being offered by the majority of well-known and highly regarded asset managers who are seeing no choice but to keep up with this growing trend, which is by no means a passing fad. You simply have to open any widely distributed investment magazine and you will almost certainly see at least one article relating to ethical or sustainable investing. Ethical investing has well and truly entered the mainstream. Ethical investments yield lower returns. Probably the most common myth of all, but also the easiest to refute as it simply does not hold water. How can a company which pays more attention to matters such as improvement in health and safety standards, reducing bribery and corruption, and maintaining a good reputation with customers not be benefiting from lower costs through increased efficiency and more business opportunities? At the very least, these extra considerations should not hinder the company's growth. Perhaps there was an element of truth to this argument when ethical investing was in its infancy and traditional ethical funds focused solely on exclusion. Typically, the excluded sectors, for example tobacco, oil and mining, have been some of the best performing sectors over the long term, which could have contributed to relative underperformance versus mainstream investments. Things have drastically changed since then. While several of these dark green funds do remain, there has been a huge rise in the number of positive impact funds launched, which use positive screens to target companies doing good for society and the environment. The idea is that these companies are better able to meet the rapidly changing needs of society through originality, efficiency, and productivity, and by aligning investments to key growth areas such as health and fitness, cybersecurity, and renewable energy. If one needs more convincing, the numbers tell a similar story. According to research carried out by data provider Morningstar in June 2020, who looked at long-term performance of a sample of 4,900 funds domiciled in Europe, including 745 Europe-based sustainable funds, the majority of these strategies have done better than non-ESG strategies over 1, 3, 5, and 10 years. This included periods of significant market drawdowns, such as the coronavirus-induced market sell-off in the first quarter of 2020, where the study showed that sustainable funds outpaced traditional funds. The simple fact that socially responsible investing is moving further away from being considered as a niche market is evidence that SRI strategies must be producing investment returns that are rivaling mainstream investments. The overarching fear of underperformance should not be allowed to cloud anyone's judgment any longer. Ethical investing is too expensive. Ethical investments have tended to command a slight premium over mainstream investments due to the added layer of due diligence involved in the process. However, this difference in the average OCF of mainstream versus ethical portfolios is often minimal and can be justified if process does in fact translate into better performance. With this said, as the market has embraced ESG, expense ratios have fallen dramatically. The growing number of passive ethical funds and ETFs is also helping to keep overall costs down, and the increased competition we are seeing with new fund launches can only help keep prices competitive. The way the market is moving, with ESG gradually being embedded into all investment processes, fund management groups will have to absorb the costs to stay competitive. Investing ethically means being excluded from many sectors of the market. As ethical and socially responsible investments have evolved, it has become less common for fund managers to apply a broad-based exclusion of entire sectors, countries, or asset class from the outset of their investment process. Any exclusion within these areas tends to be a byproduct of a screening process which selects high-quality, well-managed companies which are generating sustainable cash flows. This represents a positive screening process which is being made use of much more now than in the past. Undeniably, there will be certain sectors that simply do not appear in the final portfolio, such as the oil and gas sector. However, this is because these stocks have been filtered through the process based on poor ESG credentials, a key risk to owning those stocks. As the ESG investment universe has grown and matured, it is not hard to construct a well-diversified portfolio with exposure to all the major asset classes, including fixed interest, international equities, global infrastructure, property, and multi-asset funds, to name a few. Ethical investing involves higher risks. The strong association of ethical investing with negative screening has led to the belief that by restricting the size of your investment universe through implementing a negative screen, you are reducing the diversification and, in turn, increasing the risk of your portfolio. The nature of ESG investing can result in a smaller investment universe and therefore a reduction in investment opportunities. However, we believe the risks associated with poor management of ESG issues could be far greater. The risks of poor corporate governance are well known. However, there are also risks relating to environmental or social factors, such as costs incurred from fines and litigation, and reputational risks for poor environmental practices. Companies are becoming more aware of these risks and beginning to incorporate ESG considerations into their discussions, which means that the universe is likely to expand further over time. With a greater focus on positive inclusion, it means that negative screens are not as strict as they once were, and the universe of ethical investments available to fund managers is broader than ever before. This is compounded at the fund level, with significantly more offerings available to investors, which means they are not having to severely reduce their choice of acceptable funds. My money isn't really making a positive impact. This simply isn't true. Impact investing is centered on investing in companies which have been identified as being able to meet the needs of our society and environment, and which can generate a positive, long-term impact. These are companies involved in the provision of sustainable goods and services, such as energy-efficient home appliances, social housing, life-saving medicines, and clean water. This merely scratches the surface of the ways your money can help to support companies doing positive things for our society and the environment. On top of this, many asset managers are involved in positive engagement with companies, lobbying for increased transparency and disclosure policies surrounding sustainability. Examples of this include dialogue with retail companies regarding their supply chain management and engaging with corporates with regards to improving the gender diversity of boardrooms. Rest assured, your money is being put to good use. Let's not be mistaken. Many ethical and socially responsible funds underperform their peers, but so do many traditional funds. Does this mean that traditional investment strategies don't make financial sense? The arguments put across in this video justify the case for SRI as a legitimate investment option for those who seek financial returns whilst believing companies should be held accountable for their environmental, social, and governance practices.